Hello, Sector Watchers. Welcome to the 22nd episode of Sector Spotlight on Tuesday, the 10th of March 2020. This is your weekly update on sector rotation and anything remotely connected to sectors, relative strength, and/or rotational analysis. My name is Julius de Kempenaer, and I'm your host for today's show based in Amsterdam, the Netherlands. Rachel and Zach are with me at the StockCharts studio in Redmond to make sure that everything will run smoothly. You can always send me an email with questions and suggestions, but if you want to participate while we are live, please don't hold back. The chat box is open during the show and we will monitor what's coming in. Just don't be shy. Ladies and gentlemen, let's get started with Sector Spotlight. And here are the handles where you can reach me on social media and my email address in case you want to send us anything. While I am going to bring up the agenda, that you probably know, I also want to point out the fact that we have a poll running in the chat box. It's about the conferences, either real or virtual, that you have attended. And we hope to get as much responses as possible to see which ones are popular and what you like. And Dave Keller, the host of The Final Bar, will get back on the results in one of his shows this week. Anyway, let's get started. Today, the usual overview. I want to go and try have a look at the international markets using these times of turmoil. We'll have a break. We'll have a mailbag if anything comes in. And I think I'm going to spend quite a bit of time on some pair trade ideas, brushing up what we have open and coming up with two new ideas. Let's bring in the performances and the RRGs that go with it. On the left-hand side is the performance of the various asset classes that we are monitoring. A lot of red, a lot of negatives, and only one in absolute terms positive. No surprise that that's for US Treasuries. And the one way to the right, the big red bar, is US stocks. And then obviously we got commodities and real estate nearby. If we bring this into a relative perspective, and you can do that by clicking on the, in this case, the Vanguard Balanced Index, that's the benchmark, the yardstick that I use for these asset class indexes, you see that the strong outperformance for treasuries, the green one is the corporate bonds, and then the purplish one is the US dollar. So these are the ones that would have given you a little bit of outperformance, and the treasury is actually an absolute performance. And then all the way on the right, there is the rest, high yields, real estate, commodities, and then all the way there, the equity market. If we put that into an RRG, we get this picture here on the right, and we see that the rotation that we've been pointing out for a couple of weeks already is now accelerating in favor of the fixed income like risk off asset classes, while we have stocks now rapidly heading towards the lagging quadrant, following commodities that are diving deeper into that lagging quadrant. If we change this to a daily scale, you will see a little bit more granular of that rotation, and it becomes even more clear that we now have all the risk of asset classes concentrated in the leading quadrant, and we got stocks and real estate inside lagging, and commodities, which is actually a long-term, very weak asset class, you see, are rolling over, and I don't think that they will make it back to the leading quadrant. So they are on their way back down to lagging as well, which means that the big picture remains in favor of risk-off asset classes, government bonds leading, followed by corporate bonds. And then maybe if you want to feel a little bit adventurous, you can pick up some high yield and maybe some foreign stuff because the US dollar is really strong. If we go to the sectors, do a similar exercise here, then we have all sectors in negative territory over the last 5 trading days we're looking at. That's this box little here. Energy, minus 25. Come on, that is a serious decline. Same for financials, minus 15. The risk off or the defensive sectors, staples, utilities, healthcare, to the left with a mild minus 2 performance. If we bring that into a relative perspective by clicking on the S&P 500, we get the same sort, of course, and then you see that energy is underperforming SPY with 17%, and that we've got staples, utilities, healthcare here on the plus side. If we do that on the RRG, again, we see the clear rotation continuing to all these defensive sectors. Utilities is leading the pack. Real estate is following, despite that big drop that we had. So this is a little bit of the longer term picture. We'll switch to the daily in a minute. Energy, clearly, this is an energy. We've been talking about energy for ages as being the dog of sectors. It's been the worst sector for a long, long time already. And now it looks like this week was the final blow. I don't know. I mean, maybe we should start looking for buying opportunities in that sector. I don't know. But this trail that's pointing to the lower left, deep inside the lagging quadrant, doesn't predict a lot of good. So I'm going to keep an eye on it. It's very, very early. Same goes for financials. They got a big blow last week. They're now well inside the lagging quadrant and heading further into it. Let's bring that to the daily RRG to get a little bit more up-to-date information. Of course, the energy and financials deeper in there. This one here is industrials. That is also starting to point deeper into the lagging quadrant. And then we have this whole cluster here, and you see that real estate is now rolling over. We saw that weak performance on the asset class rotation and in the sectors, and although it has been a defensive sector being very good, it's now starting to roll over into weakening on the daily chart. And we've got this trio here, which is utilities, staples, there you go, staples, utilities, now real estate, and this one is healthcare. Not surprising with all the coronavirus stuff going on. And then there is a little cluster of sectors that is around the benchmark. So that's communication services, that is consumer discretionary, not these ones. And you got materials rolling over back into lagging, and you got technology actually picking up. It's surprisingly strong, I must say. And I've got a pair trade idea in the technology sector later on. With all this stuff going on in the US, I think it's always good to take a step back and take a broader picture view. And what I would like to do is bring up an RRG that shows the RRG for international stock markets. And these are the indexes that represent those markets. And I'm not going to show all the individual charts because that would take up way too much time. But I want to try to make it actionable, investable, tradable by putting an RRG that shows the ETFs tracking a lot of these international stock markets next to it, and go over some things that are moving in sync and some that are moving completely the other way, and that all has to do with the currency. And don't forget, it looks as if the stock market is in turmoil, but we have some very big moves in the currency markets going on as well. So I'm going to bring the same RRG, and where did I put that? International ETFs. So we've got the indexes on the left, and we've got a bunch of ETFs on the right. Now, on the right, so this one here is all quoted in US dollars. These are all ETFs. You can trade on US exchanges, and they're all quoted in US dollars. And when I started looking at this, the first thing that stood out is that probably the most interesting market from a relative perspective on this RRG, believe it or not, is China. This one is accelerating. It's been on the left. We had a weak period there, but it picked up, and now it's actually accelerating to the lead, towards the leading quadrant. We're not there yet, but from a relative point of view, and we're comparing it to the Dow Jones Global Index, it's a world stock market index. China is actually one of the better stock markets out there. So that was one that caught my eye. And then, so what you want to do is you, to make it actionable, what I always do is I bring the China ETF in for comparison reasons. I am trying to tell everybody, and I'm very opposed to using this setup here to be the sole guide for international investments because you've got a big currency effect going on in here. But you cannot trade the indexes as such. So you need an instrument to translate what you see on the left-hand side to something that you can trade on the right-hand side. So by looking at China here inside the improving quadrant, I say, hey, I need to look at something that gives me exposure to the Chinese market. And an easy way to do that is buy an ETF. I mean, mind you, all these analysis that we do on these indexes are the underlying indexes, and it creates a view, it creates an opinion on what we want to do with a market like that. And then the next step is in what I call portfolio construction, is to translate that view into something tradable. And it can be an ETF that we do here, which is very simple. It could be a future, it could be an option strategy, it could be a mutual fund, it could be anything, as long as it translates what you see on this RRG into something actionable. So for this one here, for China, the China ETF actually looks pretty good as well, which means that the renminbi dollar relationship is also in our favor, or maybe I should say it's not going against us, which is a good thing. So that makes the MCHI an ETF worth looking at. Now, if we just, let's go over a few of those, because what you see here is that there are a lot of Asian countries and regions that are inside, you know, like going in the right direction. Hong Kong is inside leading. It's losing a little bit of momentum. If we look at Hong Kong here, you see that it's actually improving. So that Hong Kong dollar relationship is in our favor, because the index itself is strong. It's in a relative uptrend, that's for sure. But we get a little bit of an extra kicker here from the currency relationship. So that's also a good one to look at. Look at the South Korean one. And I mean, mind you, I was looking at this, and these are all the countries that I hear on the news here that are heavily affected by the coronavirus. They were the few of the first countries that were heavily affected, and they seem to get out on top right now. I'm not sure if that is a predictor or they are front runners of what's there to go. But for the time being, these country indexes look pretty strong to me. And we can see that here as well, because there is a, where is it? South Korean, here, South Korea cap ETF. Here you see that it is starting to curl back up. This one, very likely, I haven't done it because I don't have the data for the, it's probably the Korean won. It's probably not in our favor. So although the index looks pretty good, the dollar-denominated translation is not in our favor. And we have a few that are in our favor, so why not stick with those? To speed it up a little bit, the other one that caught my attention was RTSE, and that is Russia. So you got China against Russia on the world stage, with China, shall I say beating Russia? I don't know. I mean, on the markets, yes, China is beating Russia. And if you look at the Russian ETF, and that's we've got the RSX, you see that that's completely in line. So the currency relationship between the ruble and the US dollar is not going against us or not going to give Russia any advantage. So if you could short, I tried to look up if you could short RSX. I'm not sure if that is a very liquid ETF and you're able to short it, but an idea could be to be long China and short Russia. And if you don't want to do it through ETFs, maybe you find some options or futures or whatever, or a mutual fund, anything. But you know, in an international portfolio, I, for example, would prefer holding Chinese, Hong Kong stocks over, let's say, Russian ones. Let's see if we can have a few more that are worth looking at before we go into the break. This is our Canadian friends, Toronto. That is probably where is Canada. Here is Canada. Oh, US dollar Canadian, not doing very well. This is daily close. Could be there. I'm not really sure about this one. If this tomorrow, because mind you, these are end of day quotes. So or these are end of days quotes, and these are probably real time. So there is always, you should always look at that at the end of the end of day, so you got everything neatly aligned in price terms. The direction, although, is very clear in the good direction. India, I looked at, there we have this looks good here. It looks like a nice hookup. If we go to the ETF, you see that that is not so good. So the India rupee against the US dollar is going against us. So the dollar is strengthening versus the rupee, because when you do this, you invest in rupee, so you lose your dollars, you get exposure to rupee, and if the rupee drops against the US dollar, you would have been better off staying invested in US dollars. That's why that India ETF is going the other way. Europe is pretty interesting because that is going exactly opposite. There you go. Here is the S&P 500. On the world stage, the US is definitely not the weakest market. As a matter of fact, it's one of the stronger markets. Despite all the big percentage losses that we see, stocks flying all over the place, in a relative perspective, the US is actually doing pretty well. And if you compare it to Europe, you see that we, as in we, Amsterdam, Europe, are going the wrong way. We're heading into the lagging quadrant. And if I put that onto an ETF, and I know for a fact that the euro dollar rate is actually going up, which means strength for the euro and weakness for the US dollar, which is in favor if you as an American invest in European stocks, because you get the extra kicker, the extra benefit of a stronger euro versus the US dollar. This was it for now. I'm quickly going to check the chat box if anything came in. We're going to look at a short break, and we'll be back right after that. And here we are again. I see we have 1, 2 questions. Stella, what does IMHO? That is, I can answer that. It has nothing to do with the stock market. It's, I don't know, Stella, but if you have kids in the range of, let's say, I don't know, 15 to 25, in my humble opinion, that's an abbreviation that a lot of people use when they text. So there you go. There's a little bit of urban talk here going on. The other one, CAR UNTO, will it ever be at a bargain? Great performing REIT. I'm going to quickly look at that because now I want to know what kind of stock that is. Let's see. Bring that up. So that's CAR slash, oh, here we are. Whoa. Really, really nice. Will it ever be? Well, I don't know. It's, what is it? Properties. Okay, defensive. I'm not sure if it will ever be at a bargain, but, and this is against SPY. Let's try to put that against dollar TSX. See how that looks. Well, again, a bargain is probably a fundamental valuation. I don't know about that, but what I do know and what I do see is that it just broke out above its relative highs, and it just broke out above a previous high on price. We tested that old resistance as support, and we now seem to hold that. And there is a very nice series of higher highs and higher lows going on. There is absolutely nothing wrong with this stock. So whether it's a bargain, I don't know. But it sure is an attractive stock in all this market turmoil. Anyway, I just brought up this sheet that I'm maintaining for myself, which gives you in one big overview my view of the world, and especially geared to the US markets. So here are the asset classes that we looked at. This is the yield curve. And here are the sectors. And the one that I changed compared to the previous version that you saw of this one is that I actually changed XLV healthcare to an outperforming stock because it actually turned back up. It goes against my pair trade idea that we're going to talk about in a minute. It goes against the seasonal pattern for this sector, but I think that what's going on in the world right now justifies an outperformance, and the trail on the RRG definitely supports that. Let me go and bring up the pair trade ideas that we have open and quickly take them for a spin. Bring you here. I have actually a list for the pair trade ideas, and we're going to look at those. The yellow ones are the ones that are still open. The other ones are closed. thru against PFG. We started that here, and that's actually doing very well. We're up like, I mean, it's probably not 18.7. It's like 187 on a plus 1,000 minus 1,000 position. So I'm going to let this go because it's doing really, really well. We have KO versus WBA, and that one is a little bit in doubt because on the RRG the trails are definitely pointing in the right direction. I am going to let this go for a little bit because I see this as a breakout and a retest, but I'm going to monitor it closely because it should not drop much further. Tails on the RRG are still supportive of this pair trade. And then the one that I just upped healthcare as a sector, which means that it wouldn't make much sense to hold any short positions in the pair trade ideas for XLV. And we're looking at XLY versus XLV right now. We're at a -4. That completely did not work out. We tried it. We started here. That was pretty good. And then in this all market turmoil, when Corona started to act up and people started to buy healthcare stocks, basically got crushed. We broke below this support here. I'm going to say goodbye to this one, especially because of the healthcare lag that's going too fast against us. So we're going to get out while it's still bearable. And the same goes for the discretionary, for the utilities. Sorry, this was discretionary. The other one that we have open was based on the seasonal pattern. That is the utilities versus healthcare. Utilities are still stronger. I mean, if I bring this up on the sector RRGs, and I bring up utilities and I bring up healthcare, where are you? Here's healthcare. Then you see that healthcare is hooking around like that. And if we do it on a weekly, then they're pretty, or sorry, on a daily, they're pretty close together. So you got utilities here, and you got healthcare all the way up with higher momentum. I'm not going to take any risks here. The seasonal pattern is in favor of healthcare, or is in favor of utilities, and tells us that healthcare should underperform pretty strongly this month, but it's not doing that in the real world. So we're going to say goodbye at a -0.something%, just to stay on the safe side, because, you know, if you lose a lot of money, you need to make even more to get it back. I do have two new ideas that I want to share with you. And the first one is coming from the international markets view that we talked about before the break. Let me get that back on the screen. So where is that international markets one? That is the one that we stopped with, the European versus US trade. And if we bring that on the ETF version. Then we have SPY, inside leading, moving to the right. And we have the European version, IEV, moving in the opposite direction. And if I bring that onto my pair trade layout, then we got this chart here. And you see how wild these swings have been over the last couple of days. So I'm gonna actually make this a little bit more quiet by creating a line chart. And then you can see that we're actually holding above this low. We broke above this resistance level, which is good. And I think that given the direction of the trails on the RRG, this has a very good opportunity to actually continue its rise. And let's look at it from a little bit longer term perspective. And you see that this trend is ongoing and just got a new impulse somewhere in February when we broke above this high. So that's a 6 to, what is it? 12, 13, well, whatever high, a lot of months high. And the way up is open. So I'm going to, with the idea that the US will outperform Europe in the weeks to come, and we can play that by buying SPY and shorting IEV, or finding some other way to short or get short exposure to the European market. The second idea that I want to share with you, it comes from the Dow Jones universe. I was looking at the RRG of the Dow Jones Industrials. Oh, by the way, in this international ETF, my first idea was to go long China and short Russia. If you bring up the spread between those ETFs, that is, we're probably chasing the market, and I didn't really want to do that. So that's why I went with the US-Europe trade. Anyway, I was going to bring up the RRG of the Dow Industrials. That is 30 names here. And I want to look at the daily, because the markets are going so fast nowadays that, you know, to have a, you know, you probably got in days what you otherwise would need weeks or months to do. And what you see here is there's a whole bunch that's flying to the right, and there's a whole bunch that's flying to the left. So you get a pretty clear and descript split between stocks in the Dow Jones Industrials Index. And two that caught my attention were Apple, because it is actually rolling back into the leading quadrant, making a very nice push into leading, and it's just happening. So we're just starting to move to start this move. And then we have IBM, which is also in the tech sector, crossing over into the lagging quadrant right here, which makes it a negative with a lot of power moving to the left. So if you put that on in this template that I have here, you see that this one is right about to break to new highs. And that's why I want to try and see how this trade is gonna work out. So we're gonna be long IBM, long Apple versus short IBM. And I put that on a sheet for you. And we're gonna monitor those as you are familiar with. Anyway, that was another 30 minutes gone. This was the 22nd episode of Sector Spotlight. Thank you for watching. Please don't be a stranger and stay in touch. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. If you want to read more about sectors and sector rotation, please go to the RRG blog on StockCharts.com. If you want to track us, please click the link below each article to subscribe, and make sure you get a nudge every time that a new article is posted. Bye for now, and I hope to see you back next week. Stay safe.